Hey friends, welcome back to the channel. My name is Sanji and today we're going to answer that question. How do you pick an ETF to either get started or add to your portfolio? Now this is a question I often get and it comes in various forms. Sometimes people will say, hey, I'm looking at a particular set of ETFs. Which one do you think I should look into? Or a question around what kind of key features do you look for when you're trying to pick an ETF? Normally I do videos where I say, if you're interested in this theme, like you want to invest internationally, or if you want to invest in Australia, these are a list of ETFs that you should consider. But in this video, I want to take a moment to zoom out and just say, in general, when you're looking at an ETF, what are some of the key things you should be investigating or trying to really understand to make a decision on which particular ETF to buy? Now, like most things in life, it's a case of there's probably 3 or 4 things you really need to consider. And then it's a long tail of a whole bunch of other things where, you can make it as complicated as you want it to be. But there are some basics you should really consider, and that's what we're going to go through in today's video. So let's get into it. So the first and most important thing is the index. What is the ETF actually tracking? What list of companies is the ETF actually going to be looking into? Now remember, what an ETF actually does is it's a fund where the ETF manager goes out and finds from a various group of other companies that actually make lists of companies to invest in, what is a good list that we should follow? And they follow this list. It's like the top 200 companies, the top 300 companies, companies that are focused on lithium, companies that are focused on the gold sector, companies that are focused on robotics, whatever it is. There are these various lists that these official companies, rating agencies, whatever you want to call them, have come up with. Usually it's companies like S&P, Solactive, MSCI. These companies will put together like a list of companies that they should invest in. The ETF company takes this list, they take your money and they go out and they invest in these companies. And the list not only has the companies, but it also has the breakdowns. Should you put 5% of your money in this company and 4% of your money in this company? Broadly, what they do is the larger the company, the more money they'll put into it. Now, it's not a complicated process though, because between you and I, we could go for a walk through the Melbourne CBD or the Sydney CBD, look at the logos on all the large buildings and figure out the same companies. What's going to be on the top 200 companies in Australia? Well, you'll have the big 4 banks, you'll have the miners, you'll have Coles and Woolworths, you'll have some of the healthcare companies like CSL, Ramsay, and then you'll probably have some other retailers that you've forgotten about, but you got to throw in there like JB Hi-Fi, Kogan. They'll all be there. Now these lists do fit into certain themes. So you might have within Australia, you'll say that you have the top 200, the top 300, the top 100, top 50, really small companies, really big companies. They'll have all these themes that they'll say you can invest in. So the first thing and most important thing you should try and figure out is, where do you want to invest? Now I know when you're starting out, that's a tricky question because you're like, I don't know, where do we start? Good area to start is Australia. Get something that covers the top 200, top 300 companies. It's not a bad decision there. You can't go wrong getting the top 200-300 companies in Australia. Then you'll naturally want to have some international flavor. And then you can figure out, do you want to just get something very broad like VGS, MSCI World excluding Australia, or very specific like an Asian focus or European focus? But that's essentially the key thing around the list of companies that you're going to invest in. Now in this section, I'll also throw out, you'll most likely come across these 3 companies, and these are good companies to buy an ETF from. Vanguard, BetaShares, and iShares, which is actually a subsection of BlackRock, but these are the top 3 that I'd say. I wouldn't be surprised if you come across their documentation. That brings us on to the next topic, which is fees. Now you've heard this plenty of times, I'm sure, but let me walk you through 2 key things you need to know when it comes to fees. The first is you're not paying for quality, okay? Higher fees don't imply higher quality. And the second is you do need to contextualize your fees as well. So what do I mean by the first thing around you're not paying for quality? Because with ETFs, these are not, they don't require human interaction. Like I said before, it's a list of companies that they have to invest in. So the ETF company takes a list and they just basically blindly buy those companies. Every once in a while, the list gets updated, they adjust the list and they adjust their holdings accordingly. This is not a case where the higher the fees you pay, the better the quality of the investment you're getting. The quality of the investment is driven by the index that it's tracking, the thing we just talked about, not by the size of the fees or the size of the team that's running your ETF. So this is a case where ideally what you want to do is pay the lowest amount you can in fees. Okay, so if you're looking at two ETFs that broadly do the same thing, they broadly track the top 200 companies, just go for the one with the lower fee. Okay, it's not a case of, oh, but it's got a fee of 0.78 versus a fee of 0.2. Maybe the one with the fee of 0.78 is better. No. Often what happens is companies that have relatively high fees, or ETFs that have relatively high fees, are very niche ETFs. They're going into a very specific sector. And they have to charge that higher fee because it's the way they can make money from this ETF. Because there's not many people investing in it, they have to charge more per person to make it kind of commercially viable for them. Whereas the really popular ETFs with a lot of money in them, they tend to have lower fees because they can afford to charge everyone a little bit of money and still make plenty of money out of it. Now, I know what some of you might be saying is, hey, what about when you put more and more money in over a long period of time? Does this difference in fees have a big impact? It does, but let's play it out. Here's an example you can do with the managed funds fee calculator you can get from the Money Smart website. Very easy to use. So the example here is, let's say you can invest $10,000 for 10 years and you're going to add an extra $10,000 every year and you're expecting returns around 7%. It can be 5%, 7%, something around that size. So let's say you're going to compare between paying 0.2% for an ETF or 0.1% for an ETF. I know you're thinking, hey, that's about double, 0.1 to 0.2, that's double. What's that going to play out to be? Well, over 10 years, you're looking at the difference in paying $950 in fees versus $1,893 in fees over 10 years. It's about $900 odd. Okay? It's not the price of a PlayStation over 10 years, and you're sitting on 155 grand overall. This is what I mean. You've got to contextualize these fees. Now, I know if you've followed the Barefoot Investor in various books or whatever's out there, you would have heard people saying, you got to minimize your fees. Barefoot's talking about like 1% in fees, not 0.1, 0.2, these kind of differences. So that's one thing. Now, I know, again, you're saying, but what if it's over 20 years? It does blow out a bit. So over 20 years, you're looking at the difference in 11,000 in fees versus 5,000 in fees. Okay, now, it's potentially real money. It's money that you're being like, okay, I can buy a car for $5,000. But over 20 years, this is the difference we're talking in fees. Some of you are saying, well, what about over 30 years? I know. Okay, now it's real money. It's the difference between $40,000 and $20,000 in fees. But it's been 30 years, okay? And you're sitting on nearly $1 million of investment. So this is where I'll sort of wrap it up and I'll say, if you're looking at two ETFs and one of them is slightly lower in fees than the other, go with the lower one in fees. That's fine. But over time, ETF fees will change. They'll probably go down over time, and that's what they've historically done. They rarely go up, they usually just go down. And if you're caught in a situation where an ETF that you've invested in is 0.1% and the other one was 0.2%, and then over time they flip, the other one suddenly gets cheaper, I wouldn't be panicking to switch, because overall the cost of switching would probably be more expensive than the difference in the fees that we're talking about. So that's why I'm just pulling this out there to say fees are important, but contextualize it to your situation as well and don't freak out too much over it. Now, the last of the big topics that I sort of look into when it comes to ETFs is the funds under management, or the market cap of the ETF. What this essentially says is how much money has been invested in this ETF. So I'll throw up on the side a list of all the top ETFs, but it's generally VAS, PM Gold, VGS, NDQ, all of these very common, very broad ETFs that have a combination of both been around for a while, except for I think NDQ. I think NDQ is quite new, so it's doing quite well. But they've been around for a while and they're very broad and they're well known and they've got very decent fees. So understandable, a lot of people are investing in them. Now, the danger you want to avoid is investing in an ETF that's quite small. And the reason for that is because of what we just talked about in terms of fees, it's in the interest of an ETF company to have a lot of people invested in their ETF. Because if they can get a lot of people invested, they can get a lot more in fees. Otherwise, if only a few people and if a small amount of money is invested in their ETF, for them to keep it commercially viable, they'll have to charge more in terms of fees. And the risk is if they have to do that for a while and that ETF doesn't grow, they might have to shut down the ETF. Now, it's not end of the world. Okay, shut down the ETF just means they liquidate it and you get your money back at whatever it was at the last point. But it does trigger a tax event for you. So a bit of a concern there. So that's why you're better off just targeting larger, more popular ETFs. Not necessarily more popular, but just ones that have more in terms of funds in them. The other thing is you also won't lose out as much in terms of the bid selling price kind of differential. You won't lose in terms of efficiency on that. So this is the key where if you have to choose between two ETFs, and again, they're very similar in fees and they're very similar in what they're tracking, go for the one that's got a larger amount of money that's invested in it, because you're going to be a little bit safer in there and you're going to less likely to shut it down over time. And also you're going to experience less in terms of inefficiencies when you're buying and selling out of it. Again, if you want to talk specifics, you definitely shouldn't be going under $100 million in market cap. I was looking through the list of latest ETFs and the size of them. I don't think you would have to go under 500 million either. Like, there's plenty of good ETFs that are above 500 million in terms of market cap that you can be investing in, and that are going to be good, steady, long-term hold ETFs. And that's really it. Those are the three key things that you should really be looking at to make your initial kind of short list and selection of ETFs. If you really want to get specific, some of the other things that you'll hear people talk about are things like the dividend yield, but that's really driven by what it's actually investing in. So there are some ETFs that are trying to generate high dividends for you, but you'll pick that up in the index. It's not necessarily something you have to look at in terms of what the yield is coming through. The other things I'll just mention about fees are two differences that I've seen. One is hedged versus unhedged, and what they're basically saying is if you want us to try and mitigate against currency fluctuations, this only really matters if you're investing internationally, but if you want to mitigate against currency fluctuations, go for the hedged version, and they'll generally be a little bit more expensive, and that's because there's a cost in managing the hedge, the currency fluctuations through various currency contracts that they have to put in place. The other area, and I think this is very interesting that they do this, the other area where you'll find the ETF is a little bit more expensive than you would expect is where it's ethical or not. And for some reason, they charge more for ethical ETFs than unethical ETFs, or not ethical ETFs. I don't know why. I think it's a case, and I've said this in previous videos and I'm happy to say it again, I think it's a case of they can do it because they can. All right? They do it because they can. They know you'll pay more for ethical, and for some reason you'll think it's ethical, therefore I should pay more. Whereas maybe in other parts of your life, ethical stuff should pay more, should cost more. But when it comes to ETFs, it's just, do you invest in these companies or these companies? Why should it be more expensive to do that? I don't know. I've said this in previous videos and people have picked up on it and made comments about it. I don't see the narrative around, yes, it's ethical, therefore you should pay more because it's a different company, set of companies. That's a small rant, but be wary of that. Another thing you don't want to worry about is the actual dollar value of each share. That's not an indication of anything. Okay, whether a share is worth $5 for an ETF or $10 or $50 or $500, and there are some that are $500 IVV, that doesn't mean IVV is worth any more than the other ones, okay? It's just how they've decided to split that ETF up into how many units has determined the value per unit. Okay, now I know it can be an issue though if, say, something like IVV, which I think is around, now it's $600, I've noticed. If you, say, have $750 you want to invest and each share is $600, you either have to buy one share or wait till you have enough to buy two shares. I would wait till you have enough to buy two shares because of the way brokerage works, and it's often a fixed fee. For you to minimize the amount you lose in transaction costs, you generally want to increase the amount that you're transacting per transaction. So meaning, because your fee is only $10 or $20 per transaction, try and buy as much as you can per transaction to reduce how much that fee is as a proportion of what you're buying. Now, after having considered all of this, maybe you're still struggling, you're not really sure where to start. You just want to kick off somewhere. Now, I have done a few videos. One was VAS and VGS, the two ETFs that are good for Australians to start with. They're good foundation ETFs. I've done another video around forever ETFs. These are ETFs that you can buy and hold for a long period of time, and they sort of rebalance themselves, which is very handy. But that being said, all of that being said, and those videos are still good, make sure you check them out. Often the case when it comes to these kind of decisions is you can also just go with the most popular option. Because like in cars, the most popular cars are actually, they're popular and they get sold a lot because they're good cars. Okay, like here is the list of popular cars in Australia of 2020, and there might be some variation here because of COVID. But what do you have? You have the Hilux, the Ranger, RAV4, Corolla. Of course, the Corolla's in there. CX-5, Hyundai i30. Like, they're popular because they're also good. And similarly, looking at it from an ETF point of view, here's a list of some of the top ETFs out there. Okay, Vanguard Australian Shares, top 300 companies in Australia, $9 billion. That's a lot of money. iShares S&P 500 ETF, $5 billion. Spiders, ASX Tracker, Vanguard VGS, Vanguard VGAD, NDQ, VAP, IOO. These are all very popular ETFs because they're actually good ETFs. They do good broad range tracking and they've had some good performance historically. Doesn't necessarily mean they'll have good performance in the future, but it's a good reference to have to consider into the future. Hope you enjoyed that video. Please do consider checking out my Instagram page as well. I do a few posts in there, and also check out my mailing list. I'm going to start sending out emails on that again. It did go a little bit quiet in the middle of lockdown, but I'm getting back into it again. So please do consider subscribing to that for more tips around personal finance and investing. And I'll see you in the next video. Bye for now.